How does the Sacramento region stack up for real estate investors? In today's video, we are going to be doing a deep dive into the macro landscape here in the Sacramento region. We're going to be looking at population growth, the job market, affordability, cash flow, and appreciation. And then I'm going to go ahead and take it one step further, and I'm going to assign a rating system to each of those categories. So if you stay till the end of the video, I'm going to rate everything on a scale from 1 to 10, 1 being the worst investment climate, 10 being the best investment climate, and then I will give you the overall rating towards the end of the video, along with my personal thoughts on what it's like to invest here in the Sacramento region. Now, before we begin, if I could ask a small favor, go ahead and smash that like button and tap that subscribe button to see more weekly videos just like this. Let's get right into it. So the first item we're jumping into is population growth here in Sacramento County. So up on the screen, I have the resident population in Sacramento County for 2020. We came in at 1.5 million people living here in the Sacramento region. Now, we did see some growth here in 2021, but those numbers are not out yet. And I'm going to go ahead and show you some data here from Redfin, which I think is really interesting. Miami, Phoenix, Sacramento, Las Vegas, and Tampa were the most popular migration destinations of any U.S. metros in October, meaning they had the largest net inflows. Now, a net inflow is a measure of how many more Redfin.com home searchers looked to move into a metro than leave. So in other words, more people are interested in moving in than moving out. And Sacramento came in at the number 3 for top metros of folks looking to move in. In October of 2021, we saw nearly 5,000 residents come in. And what's interesting here is the top origin was San Francisco. So we're seeing a lot of movement or migration within the state. Folks are leaving the San Francisco region and they are coming up and landing in the Sacramento area. And speaking of population growth, this article from Narada Real Estate Investments, which I'll link in the show notes below, is saying that Sacramento is bucking the bad trends that are plaguing California. This article states that California is seeing overall population growth, but it is not healthy. Native-born Americans are fleeing the state, and they're leaving for places like Oregon, Nevada, Arizona, and Idaho. They're replaced by lower-skilled, lower-paid legal and illegal immigrants, which hollows out the middle class of the state while contributing to sky-high poverty rates. However, Sacramento is a stark contrast to these unhealthy trends. It is receiving an influx of middle-class and working-class people from around the state who don't want to leave California. This is why Sacramento ranked number 1 in the state for one-way U-Haul trips in 2018. This makes the Sacramento real estate market much healthier since it contains a true income mix. It also allows Sacramento real estate investors more options than luxury homes and densely packed affordable units, the only types of housing you will see built in San Francisco. In addition to that, people are willing to commute 90 minutes to San Francisco each way to get the Silicon Valley paychecks, although they do not want to pay the San Francisco prices for real estate. This is increasing the value of homes on the western side of the Sacramento real estate market since they've become a de facto suburb of the Bay Area. I would also like to add that there are several more companies willing to allow remote work or telecommuters where they may work up in the Sacramento region for, let's say, 3 to 4 days a week, and then they're required to go into the office back in the Bay Area maybe once a week. Next up is the job market here in the Sacramento region. So up on the screen, I have the unemployment rate here in Sacramento County. This chart here up on the screen is from the St. Louis Fed. It dates back to the early 90s, and then it shows the different points in history where we had some peaks and valleys here in unemployment. As of December of 2021, we are sitting at 4.8% unemployment. And if you were to just draw a line all the way back, I would say that overall Sacramento County is doing pretty well. Unemployment rate is relatively low when you look at the trends over the last 30 years or so. Now, moving on to job growth, in 2021, we saw total non-farm jobs grow by about 8,800, leisure and hospitality by 2,500, professional business services, 2,100 jobs, education and health services, 2,600, financial activities, 300 more jobs, government was reduced by 300 jobs, Information had no change. Mining and construction up 1,900, manufacturing down 300, and then trade, transportation, and utilities down about 3,200. So with the exception of a few industries, overall we saw a reasonable amount of job growth in the Sacramento region, which is obviously good for real estate investing and owning rental properties. All right, next up is affordability. So up on the screen, I have a chart from the California Association of Realtors. It is the Traditional Housing Affordability Index, and it shows the numbers from the third quarter of 2020 and the second and third quarter of 2021. The first thing that I want to bring to your attention is we have the Central Valley, which includes the Sacramento region. In 2020, the percentage of folks that could afford the median priced home in Sacramento was 44%. In other words, just about 1 out of every 2 households could afford the median priced home. Now, if we fast forward to the third quarter of 2021, that number has gone down to 39%. To put that into context, that's about 1 out of every 2.5 households in the Sacramento region. So in other words, affordability in this region is going down slightly. Median priced home is just under $512,000. I think it's actually slightly higher now at about $524,000, but it shows the average monthly payment, including taxes and insurance, is about $2,330 per month. That's with the current interest rate environment we saw back in the third quarter of 2021. We've actually seen rates come up a tad, which is probably putting a little bit of additional pressure on affordability. Now, the last part of this chart shows the minimum qualifying income. This is not the median household income here in the Sacramento region. This is the minimum amount needed in order to be able to afford that median priced home. And according to the California Association of Realtors, the minimum monthly income needed to buy the median priced home is just over $93,000. Now that brings me to my next slide by the St. Louis Fed showing the estimated median household income for Sacramento County. This chart dates back to the early 1990s. We can see that we have seen an upward trend in median household income over the last decade or so. But right now, the median household income as of 2020 is just under $73,000. Now, the numbers aren't out for 2021 yet. There has been wage growth, so I'm assuming that income level will increase slightly, but it hasn't increased to that minimum annual income needed to be able to afford that median priced home. So in other words, the median household income on average is lower than the minimum annual income needed to qualify for the median priced home in the region. And now that interest rates have gone up a little bit, it's putting more pressure on the housing market. Now, even though it is becoming less affordable to purchase, this is a climate that actually may be favorable for real estate investors, because if less people can afford to purchase, it is likely going to continue to keep them in the renter pool. All right, so next up is cash flow. And in order to determine the cash flow on a property, I like to look at a couple different metrics, one of which is price to rent ratio. Now, the price to rent ratio is the ratio of home prices compared to annualized rents in a given location. This ratio is used as a benchmark for estimating whether it's cheaper to rent or own property. The price to rent ratio is used as an indicator for whether housing markets are fairly valued or in a bubble. All right, so it is fairly easy to calculate. I'm gonna go ahead and pull up the calculator here. We're gonna do this together. So let's say your average rent is $2,200 per month for your standard 3 to 4 bedroom single family home in the Sacramento region. If you multiply that by 12 to get your annualized rent, it would be $26,400. So if we take the median home price, which is approximately $524 in the Sacramento region, and then we divide that by the annualized rental income on average, which is $26,400. And again, this is just for the region. You'd have to do it specifically for your property in a specific location. That would give us a price to rent ratio at just under 20%. Now, there is a couple different ways to look at this, but Trulia has established thresholds for the ratios as followed. So price to rent ratio between 1 and 15 indicates it is much better to buy than to rent. Price to rent ratio of 16 to 20 indicates it is typically better to rent than to buy, and a price to rent ratio of 21 or more indicates it is much better to rent than to buy. So right now, the Sacramento region as a whole is sitting right at about 20%, which means that in some cases it is typically better to rent than to buy, meaning it is more favorable for a tenant to rent a property than it is to purchase a home. And that is simply a means of testing affordability. It also is an indication that the market is getting expensive, meaning it will be harder for an investor to get cash flow or yield out of a particular investment. Now, we just looked at the price to rent ratio, and as a whole, it looks like it may be cheaper in some cases to rent than to actually purchase a home. So what that means for investors is that it's likely going to squeeze cash flow a little bit because real estate prices are getting expensive. Another thing that I like to look at is something called the rent to value ratio. So the rent to value ratio is a way to quickly size up a property and determine whether or not it will cash flow. And I'll give you an example. There is something out there called the 1% rule, and it's basically a form of that rent to value ratio. What it is it's basically stating that if you purchase a property for, let's say, $300,000, the 1% rule is stating that you need 1% of that purchase price to collect in monthly rents in order for that property to cash flow. So $300,000 purchase, you would need $3,000 a month in income, and that property will most likely cash flow. Well, in markets like California as a whole, or even in the Sacramento region, those rent to value ratios are being compressed dramatically right now because real estate prices have gone up so much. So if you take the median price home in the Sacramento region and you say that it is $524,000, but the average rent is approximately $2,200 or $2,300 per month, if you do the math, you're at about a 0.5% rent to value ratio. Now, that is an indication that the property will not cash flow with those numbers. So you have to do a deep dive into the expenses up front. So you need to look at things like the cost of your taxes, your insurance, your utilities, maintenance, capital expenditures, and utilities to run that property. Now, if you're not familiar with how to analyze rental properties, I'll go ahead and link to another video that I did on how to walk you through that step by step so that you can size it up. But my point being is that cash flow numbers in the Sacramento region have gone down dramatically, making it harder to invest in real estate in this area. Now, as an investor, it will ultimately depend on what your strategy is, whether you're looking for cash flow or appreciation, and it will also depend on how much capital you have to deploy in the marketplace, because you can get one of these deals to look better if you put more money down. And so I'll touch on that here later as we go through the rating system. All right, and the last item that we want to talk about here today is the appreciation rate in Sacramento County. So up on the screen, I have a chart from Trend Graphics. This is specifically for single family homes in Sacramento County, and it shows the data going back 15 years. So for purposes of discussion, we're going to take a look at what we did in 2007 versus where we are today. Now, many of you know that we were dealing with the great financial crisis in 2007, 8, and 9. So we saw real estate prices go down dramatically during those years. But you can see here, if we go back to 2007, which was about 15 years ago, we saw the peak of the market as it was starting to roll over. So the red line indicates the average sold price, while the green line indicates the average for sale price. So we're just going to look at the red line for actual sold prices. So you can see the average home price in Sacramento County was about $400,000 in 2007. Let's assume you bought at the peak and you held till today. So 15 years later, as we go across this chart here, we would see the average sold price in Sacramento County is sitting at about $575,000. Now, my question is what was that appreciation rate during those years? Now, to determine what that appreciation rate was, I have a home appreciation rate calculator. We're going to go ahead and plug in the purchase price of $400,000. We're going to say that we purchased it in January of 2007. And then we sold it in January of 2022 for $575,000. So in other words, we're taking the average sold price back in 2007 before the market rolled over. which was sort of right at the peak. And then we're taking the average sales price of Sacramento County today. And once we run that through the calculator, we can look at the home value appreciation rate over a 15-year period is coming in at 2.45%. Now, many of you may be thinking, wow, that's really not that much if you held real estate during that entire time. And compared to the last 12 to 18 months, you would be correct. That is not that much. However, real estate generally tends to keep up with the actual inflation rate. And the government reported inflation rate was on average between 1 and 3% over the last, let's say, 15 years or so. The home appreciation rate basically kept pace with that even if you bought at the peak in 2007. So we saw average appreciation in Sacramento County at about 2.45%, which in my personal opinion, over the long run, that sounds about accurate. So we covered a lot here in this video, but as promised, I want to rate each of the 5 categories that we actually discussed. So starting with number 1, population growth. I'm gonna go ahead and rate the Sacramento region an 8 out of 10, meaning it is a favorable investment climate due to population growth. Even though California as a whole has seen some net migration out, the Sacramento region is seeing a lot of folks moving up from the Bay Area, which is increasing the population. This is a good trend for real estate investors. Number 2 is the job market. Overall, I would rate the job market in Sacramento an 8 out of 10 as well. I think we have a strong job market. We have seen job growth, we have seen wage growth, and we see unemployment sitting at about 4.8%. In addition to that, we have several folks from the Bay that are migrating up, and they are either telecommuting or working remote and living here locally. The third category was affordability, and I would personally rate this a 7 out of 10. So we are getting to the point where the Sacramento region is becoming more expensive, whether you intend on purchasing or if you're going to be renting a property. We've seen the affordability compress, and that is due to the rising cost of housing, along with more recently the rising interest rates. Now, from a real estate investment standpoint, having a growing renter pool could be a good thing. However, with the rising prices, it decreases the cash flow on your property, making it harder to find yield. Which brings me to the fourth item that we reviewed, which is cash flow. Cash flow is decreasing. I would actually rate this a 5 out of 10. It is very hard to get yield in the Sacramento region when the rent to value ratio is averaging about 0.5%. In other words, if you're purchasing a home at $500,000 and it rents for $2,500 a month, you will have to deploy a sizable amount of capital in order to get that property to break even or cash flow slightly once you account for all of the expenses to operate that property. And then item number 5 is appreciation. I would rate this about a 7 out of 10. On average, over the last 15 years, we saw about 2.5% appreciation year over year. I would say this is average, so I'd give it a 7 out of 10. Now, taking all that into consideration, the overall rating for the Sacramento region, in my opinion, is going to be a 7 out of 10 when you average everything out. Now, I think overall it is a favorable investment climate, but it ultimately depends on where you are as an investor and what is most important to you. So if you're looking to invest for cash flow, this may be a very tough market to do so in. However, if you're looking for potential appreciation down the road, given the population growth and the migration trends, I think in those areas, the Sacramento region may actually do very, very well. Now, obviously, this is not financial advice. Personal finance is personal, but I wanted to give you this rating system so that you could evaluate a specific location or area. If you like the format of this video and you would like to see more videos just like this, leave some comments below, and I will try to do this specific rating system on other locations in and around the Sacramento region. We'll drill into local markets, maybe like Rockland, Roseville, Elk Grove, things like that, so we can have this specific data for those locations. Anyway, that is going to go ahead and wrap it up for today's video. I hope you found the information useful. If you did, consider sharing this video with some of your friends and family and anybody that you think it'll help, and smash that like button. It really helps grow and promote the channel. Thank you so much. Have a great day.